Welcome to the NISM Masterclass. I am your host Sashi Krishnan, and our purpose at NISM is capacity building for the securities market ecosystem, and as part of this purpose, we sit down with market experts to gain a deeper insight and to learn from their journey. My guest today is Suresh Goyal, and Suresh is a seasoned infrastructure professional. He was the CEO and MD of NHAI InvIT. And prior to that, Suresh spent over 10 years with Macquarie Infrastructure and Real Assets as their senior MD and head of India and Southeast Asia. And he is, if I may say, the authority on InvITs in this country today. So welcome to this masterclass, Suresh. And Suresh, let me begin with take a little bit look back at history, because the InvIT regulations came in 2014 basically as a response to the infrastructure funding gap that India was facing. And given your vast experience in infrastructure, because I know you've done a lot of infrastructure throughout your entire career, can you share with us how this idea took shape and what made InvITs a necessary innovation for India's infrastructure journey? And while you're at it, can you also tell us whether India's infrastructure or InvIT journey has been different from the journey that, say, more mature ecosystems like the US and Canada had?
Yeah, so good morning. First of all, I want to thank you, sir, for inviting me for this and for such kind words. All the sessions that we have held together in which you were kind enough to be my co-panelist and we spoke about various things, and here you are, as director of NISM, and we having this conversation. So there's a lot of deja vu in this conversation. I think both you and me have seen the infrastructure investing in India evolve.
Right.
While we are not going to talk about the evolution of infrastructure, but I think it's important from a historical perspective as to where does the InvIT fit into that evolution of core infrastructure development in the country. Before 2014, infrastructure development in the country, particularly in the PPP space, was being led by EPC contractors.
Correct.
Right? And we had a lot of EPC contractors which if I may use the word, irrationally exuberant to build out and taking inordinate amount of risks, raising money from various sources including capital markets, private equity, etc., and then building it out. But the fact is that infrastructure as an asset class, once built, is quite distinct and different than infrastructure and asset class when it is under development.
Right.
Now, and the category of investors, or the nature of investors, or the ethos that they have are quite different than the investors who invest into underdevelopment assets.
Correct.
Right? Now, fast forward to 2014, in fact, leading up to 2014, the regulators, the government, SEBI were quite seized of this matter, that while we were showing tremendous growth in infrastructure development, but it was becoming unsustainable because there was not enough capital that will continue to go behind risky assets, whereas that capital was not able to find assets which were relatively less risky once developed.
So you're saying that we wanted to free up capital so that it could go back to creating infrastructure assets that were more risky.
Exactly. So 2014 becomes a watershed year or a marker in the history of evolution of infrastructure, in which prior to that, we had only capital markets funding, right, and bit of an exuberant exposures to that. Private equity guys coming in, a lot of them burnt their fingers.
Right.
But 2014 basically made a distinction between operating, built-up assets into which financial investors who really don't want to get into managing the assets themselves could participate, and that's where the InvIT regulations came into being. It is one of the finest examples of stakeholder management that SEBI did in bringing various parties on board. You asked me this question about how these are distinct than, let's say, the United States, Canada, etc. All I would say is that we certainly learned from the best regulations that were around in the region, including Singapore. And we certainly avoided a lot of the pitfalls of the issues that those countries face in the evolution of their own regulations in coming up with this. And again, credit to SEBI that at least SEBI InvIT regulations 2014 have not been static. They have continued to evolve.
Right.
And while I don't want to have this long monologue going, but maybe at a later point we will pick this up. But SEBI has always been with alacrity addressing issues as they're evolving, because both infrastructure investing, InvIT regulations, as well as participation of categories, new categories of investors is all relatively new.
Right.
So everybody is learning from each other.
So just looking at the infrastructure space itself, so India will need cumulative investment of close to something like 4.5 trillion is what the World Bank and NITI Aayog say, and the numbers are anyway very big. I mean, I don't think anybody can put an exact number to this. But if you look at the 2025-26 budget, the government has allocated something like 11.21 lakh crores towards infrastructure. And give and take another 20,000-30,000 crores, which they may add on to this because they've got surpluses. This number may hit 11.5 lakh crores or something in the current year. So clearly, if we need to step up this investment into infrastructure, capital markets will play a very, very important role. And if it's capital markets, then obviously InvITs look like possibly the solution to raising money from the capital market. So what are your views on that? And also in terms of the fact that if government needs to, you said the reason why InvITs came in was because we wanted to free up risk capital. So the government also could, seriously thinking about freeing up a lot of money they've already put into infrastructure through InvIT structures for government-owned assets.
It's a very, very important question, and the issues that you raised, which goes to the heart of reason of existence of InvITs.
Right.
Because governments ultimately are the best player as far as infrastructure development is concerned, and without going into the merits and the demerits of state putting in capital into infrastructure development versus private capital coming in, but the fact is that infrastructure as an asset class is a longer term asset class. Right. It has inordinate amount of risks that are there in the development stage, and some of those risks are best handled by the government or the state.
So the most patient capital is government's capital.
It always is. It always is, right? Because ultimately it's a public good.
Correct.
That the infrastructure exists for public good.
Correct.
Right? The point that you made that the government has been allocating a large amount of budgetary support for building up of infrastructure, etc. But we have to also see another data point, which is that as a percentage of GDP, gross capital formation continues to be in 30 to 33% category.
Okay.
So despite we making a lot of effort to allocate more and more capital, we are continue to run on the same treadmill at the same speed.
Right.
So you can imagine that if the government was to reduce due to fiscal consolidation or allocating this money more towards welfare schemes, etc., then we actually tend to slip as a percentage of the GDP from that important number.
Right.
China, for example, allocates something like 40% plus. Now we can argue whether all of this is essential or not essential, etc. But I think there is enough anecdotal evidence available to say that there is a very strong correlation to the GDP growth vis-a-vis expenditure or investment that we do in infrastructure. So what we establish is that whatever money government is allocating, 10 lakh or 11 lakh crore, etc., is absolutely essential for us to just continue to grow.
Correct.
Having said that, we would like to see that the other sources of capital, I'm very consciously using the other sources of capital, right? I'm not really saying capital markets, use the word capital markets.
Right.
How does that come in to ease pressure on the government ability to put capital in, number one. Number two, can it actually come as a cherry on top?
Right.
Ideally, we like to have 2% more, or instead of 11 lakh crore, maybe 15 lakh crore, etc., to just give that kickstart to the infrastructure investment and give kickstart to the GDP growth, a bit more sustained GDP growth.
Right.
Just I've complicated things a little bit, but the fact is that this pool of capital, which hitherto has really not invested into infrastructure. I think there have been a lot of instances in the past in which people kind of came into invest into infrastructure and they burned their fingers. I'll not take names, but I think we are all aware of that. And so there are scars which are there in investment committees, credit committees of the banks or the institutions, etc. So the structure of InvIT plays a role in that. So there is this demand for capital. We need to build infrastructure. There is this capital that is available, and capital that's available both on the long-term foreign capital and long-term domestic capital, which is coming into our infrastructure only as a trickle.
Right.
So the InvIT kind of acts as a good bridge between the two.
Correct.
I'll be happy to.
It de-risks you a little bit, and it also engenders trust.
That's right, sir. Because the structure is designed such that capital which normally does not come into Indian infrastructure can now come into infrastructure without taking the risks and relying upon the professional management of InvITs.
Right. So you mentioned China. So I just a little question. How much of this 40% of GDP is the Chinese government putting in money into infrastructure, or do they also sort of access the other sources, including the capital markets? The government is the main leader in making those investments there. Right. Okay. I mean, their private investments have happened onto the real estate side. Okay. So in my past life, when you said that I was head of Macquarie Southeast Asia, China was part of my domain at that point in time, and we really used to struggle to find opportunities where private capital could go into this. Right. Okay.
So it is largely domestic, government driven, and government continues to do that. They also have the benefit of that they have higher savings than us, and they also have export surplus which is sitting in there for them to then plow back.
But I would tend to believe that markets like, say, the US and Canada would actually have resorted more to capital markets than to government.
Oh, absolutely correct. Absolutely correct. Right. Even a tiny country like Singapore, for example, acts as a market, but it's a great market for being able to tap into long-term, and I'm using the word long-term institutional capital that can come into infrastructure.
Okay. So do you see InvITs becoming then mainstream over the next couple of years, like they have become in markets like Singapore, in India?
Sir, you have been a man of markets, and I have been your student. कहते हैं ना कि हिंदी पकड़ा है, so allow me to speak in Hindi also. कहते हैं ना कि दो चीज में से या तो टारगेट या टाइम, एक ही का प्रोजेक्शन करना चाहिए, दोनों एक साथ नहीं करना चाहिए. So I would not say कि it will be possible to do in 2 years' time. But InvITs, since the time I took up this role with NHIT InvIT in late 2020 till 2025, I have witnessed a huge transformation just in that. Now, if that is any indication on how the InvITs in the future would be, it makes me extremely passionate and optimistic about what the InvITs could be and how the transformation would be brought on to. We really not explored the investor side of things, right? And what do they see and how it benefits them, etc. But I see that we are reaching a stage in which InvITs will become a prominent asset class and would certainly start to be a part of the portfolios of institution, as well as certainly more suave investors.
Right, okay. So, but as of now, I mean, in spite of whatever our projections for the future are, SEBI has registered just 27 InvITs. And out of those 27 InvITs, with a total AUM of something like 7 lakh crores, just around 5 of them are public. So, that reflects on the retail participation as well as the number of InvITs. So, one thing is, what explains the fact that InvITs are still, private rather than, not using the public route? That was one question that I had. And the second question is there something that's holding InvITs back from listing publicly or going the public route? And, is it liquidity? Is it enhanced, compliance and governance requirements and standards? Is it valuation concerns? What is stopping, people who want to raise money through InvITs from getting to the public markets? Because we've seen, for example, equity. Equity is sort of boomed out. You've got, nearly every third household in India now seems to have a demat account and owns equity. Look at mutual funds, 75 lakh crores. So those parts of the capital market have really sort of boomed, if I may say, over the last, say, 5-7 years. It's not very long.
Yeah.
So what's holding that back?
I think there are three parts,
Sure.
3 points that you touched in this question, and
Right.
I'll try to answer them in 3 parts.
Right.
First one is with regard to whether 27 is a good number, and I can see a tone of disappointment in your this one, that with so much potential, why only 27 and why only 7 lakh crore?
Right.
Why not more? So we'll just address that.
Sure.
The second part is private versus public.
Correct.
Right? What is the distinction between the two? And the third part is what can be done to make it more mainstream.
Correct.
Right?
Exactly.
Let's try to give structure to this. So the first part is with regard to is
27
7 lakh crore, etc.
Exactly.
I'll try to be an optimist here. Otherwise, we will.
We won't survive in the
We won't
capital
survive, right? I mean, you are a veteran in this industry.
Right.
We need to be optimists, and we have seen in our careers.
Right.
Yours is much longer than mine, in which it takes time for things to become mainstream.
Right.
We need to be patient. While I agree with you, there's only 7 lakh crores of assets under management, but the fact is that of that 7 lakh crore, uncannily, and I do hope it doesn't happen, we have not had situations in which there are allegations of misappropriation, unethical conduct, right? All sorts of things that happen in the capital markets,
right.
at the company level, at the stock market level, and at the various intermediary levels, etc.
Right.
And I think the credit of that goes to the robust regulations which we just touched upon that SEBI has come about, right. And also that the nature of sponsors who have launched these InvITs have also been such that who would care for their reputation. They would want to be able to access capital markets more and more, and that's why everybody is being very, very careful.
Right.
So I would like to address this point. The foundation is good.
Yeah. So the 27 reflects the quality of the sponsors.
Exactly, sir.
Exactly.
That instead of if this number was 100, and out of that we have had 5 where
Correct.
the issues were there.
Right.
Thereby creating a black mark on the balance 95,
right.
That would be an area of concern.
Correct.
Rather than to say, I have 27, all 27 performing very well, to the best of
Correct.
my knowledge.
Right.
To the best of my knowledge, there are no issues
right.
that SEBI has. SEBI does
Correct.
regular
Correct.
inspections
Correct.
and everything.
Right.
So there are no problems in that.
Right.
So it's a strong foundation that we are laying. I like to bring just a small other aspect to this, and this is not related to InvITs, but how allocation of capital happens towards alternate assets.
Correct.
I mean, these are all ultimately alternate assets between
yeah.
infrastructure and real estate,
right.
Infrastructure including energy. Generally, sir, if you are to just take a global sovereign funds, pension funds, insurance companies, etc., and look at their total assets under management, they would allocate circa 10 to 15% towards alternate
Correct.
assets, right?
Right.
So in their portfolios, there will be large allocation to public markets, there will be large allocation to debt, there will be large allocation to traded equity,
right.
etc. But allocation to alternate assets currently is order of magnitude 15%.
Right.
I have been in infrastructure investing and been talking to international investors for the last circa 20 years or so, and I have seen this number gradually go up.
Okay.
So this number is growing as a percentage, and the total assets under management are also growing. So this number is on an absolute basis, number is multiplying. And that capital is essentially coming into Indian InvITs also.
Okay.
I think there was
right.
a point that you made that largely it is foreign capital that's coming in. The Indian institutional capital, it is a large pool of capital. When I say institutional capital, I'm basically talking about investors who tend to invest into infrastructure, which is sovereign wealth funds or pension funds or provident funds of the corporates, insurance companies, large treasuries allocating some part of it. They have started to now invest into InvITs. And the journey has only been, I think post-COVID is when we are beginning to see the evening of the 27. When I took up this role at NHI InvIT, I think the number was less than 10.
Okay.
Right. So this number has actually creeped up quite significantly in the last 5 years. in the last round of NHAI InvIT, EPFO came in with very sizable chunk of 2,000 crores.
Yeah.
So, in a nutshell, I think those listeners who are watching this, trying to understand InvITs, I think we are on a solid foundation. It's a good growth. The world example has told us that this allocation will continue to grow. Indian domestic institutions have now made a beginning, and I'm quite confident it will continue.
So, Suresh, you are talking about institutional investors.
Yes, sir.
So, those are private InvITs. So, the second question I had was, why not more public InvITs?
Mr. Gadkari has been talking about it, that,
okay.
average Indian, and this is something that he always had this conversation with me heart to heart, is that ultimately we are building this infrastructure in the country, and the infrastructure is largely paid for by people like you, me, all the crew that is in this room,
right.
Your driver, my driver,
right.
Your parents, my parents, etc. And if they're paying for it, in what way can they get a benefit out of what they paid for,
correct.
Right? Because ultimately a national asset.
Right.
And your point that you're making about public participation is absolutely pertinent one.
Right.
But sir, I also believe, as a good fund manager and a responsible finance professional, is that one has to go through a certain journey of evolution before a product is put in front of the public.
Right.
Public needs to understand the product. The risks that get associated with cannot be thrust upon that public, right? They should have been tested before. There should be a track record that should be established before. The governance processes, systems should have been tested, right? A bit of a hiccup that normally go through should have been there, because if you think about it and you get in public to come in quickly, and for whatever reason, a situation like COVID happens, or some governmental intervention takes place in which some infrastructure asset class suffers a bit of a blow. On the long-term basis, it will continue to deliver, but there could be a blip. Public may just get scarred, may get
right.
burnt,
right.
and we could jeopardize a very good asset class. Having said that, I'm sure, sir, you would be aware that last month or earlier this month, SEBI has come out with guidelines on how to make private InvITs into public.
Right.
Earlier, the thresholds were quite high. There were lock-ins on the investors, and it was rather difficult for anybody to move from private to public. SEBI recognizes that all these private InvITs need to move to public. So those thresholds have been reduced. Lock-ins are now applicable only on the sponsor, but
right.
existing investors do not suffer lock-in. So I expect that it will move in.
Many people may move from private to
They
public.
will certainly move, sir.
And their subsequent fundraising could be from the public.
Yes. I'll just take 30 seconds more on this, given that this purpose of this conversation is for people to understand what InvITs are. I think the word private is
right.
a bit of a misnomer.
Correct, it is.
Because it is not private, it is listed.
Listed, yes.
Except that retail investor with a single unit cannot buy it.
Correct.
Whereas the thresholds now are quite low, right?
You have reduced that to 25 lakhs now.
Yes, 25 lakhs. Actually,
crore.
it's 25,000 units what the stock exchanges have implemented
Correct.
right? It used to be 2 crores and that's
Right.
come down quite significantly.
Right.
As well as the minimum issuance used to be 25 crores
right.
to one investor. Now that's also been brought to 1
down.
crore,
Correct.
right? So the journey one has to see it is that it was here. That product was positioned largely for institutional investors who
Like
can understand the risk,
companies,
etc.
yeah.
Then it's kind of come here,
Right.
and now we expect a natural journey for it to go public, right?
Okay.
And what gives me confidence is that when it goes public, there'll be mighty long experience that would have been before, right? For the public to say, okay, this is how the track record of the management is, this is how the payment record is, this is how the distributions have been,
Right.
this is how the performance have been, the risks have been tested in the market before,
Right.
so they can go more confidently.
Okay. So, Suresh, you've been talking about your stint at NHAI, and the NHAI InvIT is seen as a benchmark InvIT, and it has monetized something like 2,600 kilometers of highways and raised around 45,000 crores. So, could you walk us through its the model that was followed in NHAI and what made it so successful?
At some point in time, I'd like to write a case study on this because I think it's
So could you give us a summary of that case study
Okay.
today?
I'll take a couple of minutes to just talk
Sure.
about it. I think we are all God-fearing people. So I think there is an element of destiny that comes through, right? When the stars get aligned, and that's what happened in NHI InvIT also. And I ended up having the opportunity to lead it. You have to step back that NHI as an institution has always been quite successfully managing PPP projects. So they've been managing third-party capital, they've been managing institutional investors, etc. In fact, 2012, 2013, when I was at Macquarie, we were the first ones to have acquired a road asset as a financial sponsor. Before that, it was only the EPC contractors used to own the road assets, which now has become the norm, right? All built-up road assets are owned by financial sponsors. So the journey that started in 2012, 2013, and I was lucky to be part of that, then led to TOT, right? And then another mode of monetization had to be opened, and that's why InvIT happened. So number one, NHAI had the capability and the institutional capability to able to handle third-party investors, institutional capital. That's one. Number two, the assets that go into an InvIT do require a sort of commercial arrangement. You can call it concession agreement. It kind of gets called by different names. In airports, it's called OMDA. In roads, it's called concession agreement, etc., etc. But essentially it's a concession agreement which gives you the right to toll and an obligation to operate and maintain that asset. Right. And the end of it, it terminates, and the asset flips back to, or the concession flips back to the grantor, which is in this case NHAI. So NHAI had a very robust arrangement already established, which was also bankable. The third one was that NHAI had been running these TOT programs under which it had already achieved success by having financial sponsors come in. But what it had not been able to do, and it goes back to the point that I was making earlier, is those institutional investors, the insurance companies, the pension funds, wealth managers, treasuries, etc., they had no way to participate in this. Right? They cannot give it to Mr. X or Mr. Y or invest into his or her company. They would ideally like to be just a financial sponsor. So that's where NHI InvIT came into being. And I got the opportunity to lead that. We started with about 8,000 crores in round one. And we had to be extremely careful in making it distinct between TOT and InvIT, right? Because both were targeting different asset classes, different investor classes. And in about 4 years' time, we were able to scale up from 8,000 crores to 48,000 crores. And something that we really don't talk about is that it's private listed, institutional, but it is the only InvIT in which we were able to go up to 400 investors. Right? Only 2 were foreign, and rest all, including NHAI being the sponsor, I would say 397 or 98 were domestic institutions, which included EPFO, large mutual funds, insurance companies, etc. So in a way, perhaps we took the lead in ensuring...
You democratized InvITs.
Exactly, and which then becomes easier for other InvITs to come through.
So you're talking about TOTs and securitization, other modes. So how are InvITs superior to that, or from your NHAI experience, were InvITs a better way to sort of monetize these assets?
This is it's a great question, because I could now give you an example, use this as an example of the first question that you asked me, right? 11 lakh crore being committed by the government, etc. And perhaps my answer then was a bit bland. Now this could be an example to that question also. So look at this way, sir. I think one thing that we all agree is that NHAI has done a fabulous job in building a national network of highways. And you can travel anywhere, you will get good roads, 4 lane, 6 lane, etc. And NHAI continues to invest. But we also agree that NHAI has taken a heavier burden of making those investments, let's say, than the private sector, because private sector perhaps was not best suited for putting the risk capital in to build new infrastructure.
So higher burden in terms of leverage?
I mean, they've just put in capital. Out of the 11 lakh crore, if my memory serves me right, about 25% is towards roads. So you can imagine, but we are talking about circa 2.5 lakh, 3 lakh crore. And this 11 lakh crore, if you just go be go back 5 years, and the number is roughly the same, 10,
Right.
11 lakh crore, etc. And NHAI allocation is about 25%. That means we are talking about 2.5 lakh crore per year,
Correct.
right? That's a massive amount of government money that has gone into building this road
Right.
infrastructure.
Okay.
But then there is pool of capital, which you spoke about, which we would like to have to finance this. NHI had a leverage of about 3.5 lakh crore on its balance sheet, which was there in the media. And TOTs were there, but TOTs can only be sold to somebody who knows how to operate, maintain roads, etc.
And
right?
just for the audience, TOT is toll, operate,
Toll,
and
operate and transfer, in which basically NHI takes a bundle of roads and does an auction,
Right.
and people who have the ability to not only toll the road but operate and maintain it for a defined period,
Right.
take that bundle, give an upfront money to NHI,
Right.
and then they take the toll minus the expenses and they give returns to their
Correct.
investors.
Right.
But how do you have these pools of capital, which anyway are scarred of investing into infrastructure?
Right.
Find infrastructure a bit complicated. How do you get them to invest into infrastructure, right? And certainly toll roads. And that's where the NHI InvIT came into being. So it's not come at the expense of TOT. TOTs have continued to raise capital, and InvIT came in as an adjunct to that to target this pool of capital. And here we had an investment manager, which under SEBI InvIT regulations need to have 5 independent directors.
Right.
And the government had only 2 nominees.
Right.
Which is, despite it being a government sponsored and a government owned investment manager, only 2 government nominees, 2 investor nominees. I was the 5th one as an MD, and 5 independent directors.
Right.
We have a project management company which is responsible for operations and maintenance of those roads. And then we were able to offer this as a package to the investors
Right.
who came in, and it's been a successful experience for them. So I see a bright future for NHI InvIT.
So, Suresh, you were mentioning that among those 400 and how many investors did you say?
About 400, yeah.
400 investors, just 2 were foreign investors.
Yes.
But if you look at it at an aggregate level, almost 32% of the total investors in these InvITs
Yes.
that are, these 27 InvITs are foreign investors.
Yes.
So I know maybe an NHI is an outlier. And, like 21% of the investors are, Indian sponsors, 23 are around foreign sponsors.
Yes.
So you do have a large amount of foreign sponsors and foreign investors who are, excited about Indian InvIT. So you still don't have the pension funds and the insurance funds and the wealth managers, as you were talking about, who have sort of participated in this. That's what data seems to suggest to us, right? Many of the regulators have now sort of opened out this space to their sort of constituents. For example, the insurance regulator now allows up to 6%. The pension regulator, I think, allows up to 5% of pension funds to go into this.
Yes.
So do you see that, supporting more and more of these institutional investors to coming into InvITs as opposed to the foreign sort of investors?
Yeah, no. So, sir, I think, first of all, we should not really have a very hard distinction between foreign and domestic here.
Okay.
Because let's look at it this way. It is ultimately a product which is registered in India and by SEBI.
Correct.
It is, the underlying assets are Indian. They continue to be national assets.
Right.
The distinction is that the asset is not getting privatized. It's just you have a right over to toll it. The asset remains Indian. And it just so happens that the initial capital that comes in and probably the subsequent trading is more foreign than domestic. And the reason for that is very simple, because it takes time for things to become mainstream. Right? Infrastructure as an asset class around the world also is not a very, very old story. I think not more than 50 years ago. But the Macquarie, where I was previously working, was perhaps the first institution in the world to have identified infrastructure as an asset class.
Correct.
Right? In the last 5 years, we have seen, not only the pension funds, etc., but even the mainstream private equity funds, global large private equity funds, have also set up infrastructure funds,
Right.
because everybody's seeing infrastructure becoming more mainstream. So they have the advantage of legacy. They have the advantage of having learned how infrastructure as an asset class behaves in a lot of other countries over the last 20, 30, 40 years or so. In India, the story is only about, while the regulations came in 2014, but I think the real kickstart or the J curve started
Right.
from post-COVID.
Right.
at NHI, one of the mandates, because we were government sponsored, one of the mandates we had was not to take the easy path and just explain it to 5 foreign investors, take their money, give it to the government, but also to, probably exactly the same role that you are playing, right? You grow the market, create capabilities, right? So that, ultimately, so it was like, you can imagine that 2 foreign investors, they were willing to cut 25% check each, right? That's the maximum they can do. Under the InvIT regulations, one investor can do only up to 25% and no more, right? So there's a cap. So they were willing to do that. And we could have found a third one and the fourth one also and be done with it. But those two did 25-25, but the balance to 50% is with 400. So you can imagine the effort that went into getting this 400. But what I saw that this number of 400 was not there when we did the first round. First round, it was only 27.
Right.
From 27 to 400 in 4 years. Right. So you can see how quickly the product has been understood. Number one. Number two, I'm going a little technical, sir. In InvITs, infrastructure as an asset class, there are two kind of assets. One is in assets where there's an inflation pass-through.
Correct.
Right. And then they have their revenue growth, revenue line growing in an escalating manner.
Correct.
Underpinned by whatever the usage pattern, like traffic or whatever it is, and the inflation. So it kind of continues like this. And the second one is flat nominal, which is essentially in transmission, renewables, etc. Right?
So there's a regulatory return that is.
It's a regulatory return, flat line. Right? There's no. Out of that 7 lakh crore, large amounts of money have actually been raised in asset classes which are escalating.
Okay.
Right. Most transportation assets fit into that category.
Correct.
Now, in that, there's a distinction between yield and IRR.
Correct.
Yield is what you get quarterly, half yearly, annually.
Correct.
Right. But then there's an underlying capital growth that's happening.
Correct.
Right. So, on an overall basis, you will end up making, let's say, low double-digit teens between 12-14% or so.
Correct.
Right. But your yield in the initial years is typically lower.
Correct.
Institutional investors understand that.
Right.
They are happy to live with the lower yield because they like to hold it for 5 years or so. And since an inflation pass through, it matches with their liability profile on the other side. Right? So they want to hold it for longer.
Right.
Pension funds, etc., insurance companies, etc. Retail investors sometimes are not able to make the distinction between yield and IRR. They just compare it to what I'm getting today vis-a-vis if I were to put this money into a capital market or a bond, what will I get?
Correct.
And that's where the retail investor takes time to get warming up to this, and they want the yield to hit a particular mark when it's bond plus.
Correct.
And then they invest into that. So now we are hitting that mark. Most of those InvITs now hitting that mark, and we expect more public participation.
So therefore the retail will start getting it because they're able to benchmark that to say a debt return or a debt fund return or whatever it is.
So if you and I end up having this conversation in 2 years' time, we will be reminiscing about this.
But what about liquidity also for the retail investor? Now that you mentioned that they are now a benchmark in terms of what to look for in terms of yield, but what about liquidity?
So liquidity is always important. It's important for even the institutional investors unless and until they're not looking to
trade. But institutional investors typically come in saying, I'm willing to hold into perpetuity.
Yeah, I'm using the institutional as a monolith, but it's not so. But for example, institutions like mutual funds, right? Bank treasuries, wealth managers, etc.
So they
do need liquidity. They do need liquidity because they are not only they need liquidity, they need regular updation on NAV also, because that's what they are reporting back to their unit holders. So, of these institutions, I think we are still having very low participation from this category, which is where I expect more to come. And liquidity is extremely important, and that is why when SEBI has reduced the trading lot from 2 crores to 25 lakhs and then leading the path up to public, it is to boost up liquidity.
So you're talking about SEBI and the fact that the InvIT regulations have been evolving over time, so they have not been static.
Yes.
And recently also SEBI came up with a set of regulations redefining who constitutes a public investor, the reporting timelines, reducing the investing threshold. Even the fact that at the investment level, they've said that holdcos can now offset sort of negative cash flows with positive cash flows. So, What do you think the impact of these reforms have been in shaping the market?
I think it's if you were to consider this slightly without getting technical here again, that the end point, the starting point was 2014, and the intent was to create a product in which we can enable the government and the private sector to recycle capital, lighten their balance sheets, etc., by tapping into the long-term capital that sits there, which is unable to deploy. From that, now that's been established, achieved, and now we have reached a stage in which the next milestone for the regulator and all the decision makers is to make this is mainstream.
Right? Get more public participation.
Exactly, more public participation. Let's not forget that currently SIPs are in the range of 25 to 28,000 crores or order of magnitude. Right? That's a massive amount of money that's moving into capital markets. And that money would need to diversify at some point in time. Right? It's good to have grain going in the public markets side, but public markets are volatile. If you had entered at the wrong time, probably you don't make a return for a long period of time. There are certain indices within the sectors and indices within the main market itself, which have really not performed very well. They would have gone down, gone back. So there's always a need for an asset class which has more predictable cash flow, much less volatility, high degree of correlation to GDP, inflation pass through, and that allocation of capital needs to sit not at the expense of allocation to the public market, but adjacent to that. And we expect now that when public is reaching,
so all these boxes get ticked off by InvITs.
Yes,
exactly.
And that's why. So having reached a particular stage of maturity in the public market side, the public would also start to look for these products, and that's why SEBI is making these products available.
So in this entire conversation that we have had, we've broadly been talking about transportation and power transmission. They seem to dominate this InvIT space today. Now, I know, whereas in the, let us say, real asset markets, as we see it today, you could have a lot of other adjacencies like, telecom infrastructure and so on. I think there is a whole new class of assets that will also come in that can be, put into InvITs, like, for example, data infrastructure, digital fiber, renewable energy, social infrastructure. So how do you see that space evolving?
So your questions are all, forward-looking.
Look at the kind of data centers that are now being set up in India.
Exactly. So, sir, I think we are having this conversation at a point in time in the evolution of the infrastructure development itself. Number one is we have more roads and more renewable assets or more transmission here.
Correct.
Actually, transmission is only two from that perspective. Because there is a ton of volume of assets that have been built by the government and by the private sector in the past 10 to 15 years, right? And they were just ripe for it to be recycled, because those sectors also continue to attract more capital in terms of more development, right? So it's kind of virtuous cycle that we have hit as far as these 2-3 sectors are concerned. Then there are other sectors. There is airports, telecom towers, digital infrastructure, which includes fiber optics. It could include warehouses. It could include social infrastructure, hospitals, etc., etc. Large part of these infrastructure actually sits with the government. Right? Apart from the airports, where there are few private players, right? But large parts of this infrastructure actually sits with the government. And I would have expected that based on the success of NHI, InvIT, and PGCIL, the government would go ahead and sponsor more InvITs, or probably launch a national InvIT, so that, because InvITs need not be sector specific. The regulations can be.
Can I sort of interrupt you? What do you mean by a national InvIT? That means you have multiple assets?
It could have multiple assets. There is nothing in the regulation that says that InvIT has to be only roads.
I know, but I thought it was easily understandable if you had only one kind of an asset so that the investor could understand it. But if you've got multiple assets, then that makes it that much more complicated for an investor, isn't it?
Okay, look at it from the perspective of a retail investor, right? Now, retail investor is not interested in knowing how the road operates. When does the tariff get set? How the tariff is calculated? Who pays and who doesn't pay? Single trip, double trip, multiple trip, and all kind of stuff, right? Ultimately, the investor is looking at it as a financial instrument. And as long as they have the confidence that the financial instrument would uphold what's been promised to them, they would invest.
Okay.
The theory of diversification tells us in the finance, I mean,
Right.
you are a professor of finance,
Right.
you know that the diversification is always good when it comes to investing.
Right.
When you are investing into a sectoral InvIT, you are still taking the risk that may come in on that sector. Now,
Correct.
if that was to be balanced with another sector, which is uncorrelated, but
Yeah.
less correlated to that sector.
Correct.
For example, roads are more GDP correlated,
There could
whereas
be
energy
natural
could be
hedges
less
also
correlated.
between
There are
these
natural
assets.
hedges, right?
Right.
You could link inflation escalating tariff to a non-inflation escalating
exactly,
tariff, so
right.
that's thereby they're bringing about a balance between the overall cash flows, etc. So I do believe that there should be, and probably
We should explore these kind of
we
structures.
should explore this, and probably through NISM and SEBI, this conversation needs to be had that the other asset classes,
Right.
which currently sit on government's balance sheet,
Right.
we tend to forget that large amount of infrastructure assets also sitting on state governments.
Correct.
And those finances are not in the greatest of the shapes.
Right.
Right? We need to deploy more capital, but that capital has to come from recycling of
Correct.
their existence that they have.
Right.
So, should we have a lot of government-sponsored InvITs, or should we have a national InvIT? Right? It's something that probably requires more intense discussion than what we've been having.
Right. So, just to sort of segue a little bit, InvITs are allowed to, leverage. So they can actually borrow from the debt markets. And I think there is a regulation which says that between the InvIT, the HoldCo, and the SPV, you can't be leveraged more than 70%, if I'm not mistaken.
50, start with 49 and then kind of go up.
Go up to 70, including some rating requirements,
Yes.
etc. So do you see this as a great opportunity for building up the bond markets also? Because this is an asset class that can leverage, raise money from the capital markets, build out the bond markets, and also then create assets that are nationally important.
Yeah. So there are, fundamentally what you said is correct, because most of these InvITs are AAA rated.
Right.
I think all of them
All
are,
of
if
them,
I'm not
right,
mistaken,
right.
That makes it naturally very, very attractive from a bond investor's perspective. And
exactly.
Because a lot of institutions have this requirement that they can hold only a certain category and above, rating and above bonds.
And you said predictable cash flows,
And predictable cash
underlying
flows,
assets that
absolutely.
are real and tangible.
Correct. And something that we tend to forget is that most of these concession agreements have some sort of force majeure also built in,
Correct.
right? If there is a some force majeure event, or if there is a lower cash flow, then the automatically the concession period extends, which actually provides a lot of cushion
right.
to the bondholders
Right.
or debt providers. There are two areas which still need more working. We were in fact amongst the first, if not the first issuer, amongst the first issuers of long-dated debt in our InvIT, which was also hugely successful, 7 times oversubscribed in about 7 hours. And we have 10,000 plus on bondholders, which is kind of rarity in the infrastructure space. And we were able to do bonds up to 15 plus years.
Right.
But how much is the market for such long dated bonds today? Because the yield curve is still very, very flat, right? And so that it's still being discussed in the boardrooms of the investment managers of various InvITs as to should you be taking shorter tenure bonds, right, which is relatively cheap, and then go about refinancing it, or you lock it in for long term, 15 years, etc. Then you have to weigh that in against the bank debt, which if it's an inflation pass through, and the bank debt is also resetting, linked to inflation in some way. So when you're taking bonds, you're locking your coupon for a longish period, whereas the bonds the bank debt allows you to have more correlation to the inflation, which is to your revenue, etc. So I don't think the bonds would replace this, but yes, I see more and more bond issuances coming through. Because it's just AAA, there is an appetite for it, underlying assets are good, leverage is low, good quality governance. So I do expect this to happen more and more.
From an investor perspective, does the taxation play a very important role in the decision as to whether to get into an InvIT or not? Because there is a challenge, because it's a very complex structure. The income streams itself are so complex, and therefore the taxation structure also becomes complex. And for certain interest income, for example, you treat it as a pass-through. But if it's capital gains, then, somebody pays for capital gains. So it gets a little complex over there. So how does an investor sort of negotiate that taxation space as far as an InvIT is concerned?
In fact, this is one of the biggest detriments to an average investor's participation in the InvITs.
Correct.
And the same applies to REITs also.
Right.
The structure is essentially the same.
Right.
On a lighter side, I tried to explain this to my father.
Right.
That
Right.
he's in his 80s, pensioner, and then he could invest into InvITs, and which he could.
So did he invest into InvITs because you managed an InvIT, or because he felt it was a good instrument? If I may ask you that.
I'm not a good son, so I was not able to convince him to do that.
Okay.
And where I failed was exactly the point that you just said, is that the returns to the investors comes in three ways, right? There is an interest income, which is coming because the SPV gives trust give loans to the SPV, it gets repaid. There's an interest that's carried through. It is not the interest that you're taking from outside, it's an internal interest, but it's an instrument, right? So it's a pass through to you. The second one is the dividends, and the third one is the return of capital.
Right.
It does require someone to have access to a CA to be able to file one's tax returns better.
Okay.
Right. I think I would not want to put pull a wool over it to say it's all good and everybody understands that. We have had a lot of conversations about this. Can this be simplified? Can SEBI do something? Can the tax authorities do something, etc.? I think everybody is seized of the matter, but given that they ultimately sit under the premise that 90% of the money has to be returned, or the cash flow has to be returned.
Correct.
Now, if 90% of cash flow has to be returned, then we have to adopt this structure in which the stream would come through three ways of return of capital, dividend, and interest.
Correct.
So, I would say, given that Indian investors are usually very, very savvy, and the kind of investors we are targeting to have them invest into this, they certainly would get it.
Okay.
But yes, this is a handicap.
Okay. Talking about the investment manager himself, there are certain very, very specific sector risks, as you were talking. And you were talking about, how can we have a national InvIT where we have multiple assets which tend to sort of diversify that entire portfolio. But I was just curious, going back to your previous comment, in terms of how does that investment manager actually sort of assess what kind of traffic will be there on the roads, whether there will be traffic shortfalls, whether there will be change in the tolling rates, whether there will be unusual events. Nowadays you have climate events that happen every other day that wash roads off. How does the investment manager get onto the top of all that? I just wanted to understand that, because you specifically mentioned about hedging and the fact that there are specific risks to how managing this these assets.
Right. For the benefit of our listeners, and clearly they want to understand the InvIT. So there are 5 entities. There is an investment manager, there is a trust, there are SPVs, there is a project manager, there is a sponsor, and then of course the lenders. Right. So there are the other entities that interplay with each other.
Right.
The benefit of a segregated structure in which there is investment manager, SPV, project manager, trust, and the sponsor. Let's keep the lenders out for the time being. There are advantages to this structure, and the advantages are that in a company structure, the O&M capability sits within the company.
Correct.
If something goes wrong in the governance, the good O&M cannot salvage the project. Everything goes down.
Right. Exactly.
Or the company may be fantastic, but the operation and maintenance could be not so good. And the company is not able to get third party to fix that. In the InvIT structure, what's been recognized is that the asset is distinct. It requires specialist skills to do operations and maintenance.
Correct.
So that's why you get agencies which will do it, which will get paid for it, which will be held accountable, right? And it is completely disclosed and transparent. They have to give a quarterly certificate that they are managing it as per the concession terms. Right? Otherwise, they will be held accountable.
Right.
There's a trustee which is ensuring that governance part of it.
Right.
The investment manager is what you can call it as the head of the body, right? That it's got to do the thinking. It's got to ensure that project manager is doing its job, right, and the funding is proper, regulations are being met, etc., etc. And the investment manager governance is structured such that the sponsor is not holding the majority. 50% of the directors are independent.
Right.
Why I'm emphasizing on these points is, if you look at it, there's a lot of professionalism that is being brought in. There is a lot of segregation of responsibility that is being brought in,
right,
while holding the investment manager overall responsible. Then the second part of the question that you asked me was, how the hell do they do it?
Right.
So the fact is that it is actually, if I use the word, use the cliche rocket science, it's actually not a rocket science.
Right.
Infrastructure as an asset class, large part of risks are managed or addressed in the concession agreement itself.
Okay.
If the concession agreement is not allocating the risks properly, then the asset class does not become investable or bankable.
Okay.
Right. In the case of the sectors where we have seen more InvITs coming through and more foreign capital or domestic capital come through, is that concession agreements have been held robust.
Okay.
The changes in the concession agreements have been prospective, not retrospective, right? And there's been enough anecdotal body of experience that people have to say, okay, I can invest into this.
Okay.
There is always the technical knowledge that is required to understand traffic, the projections, etc. But if the tariff setting is transparent,
right,
which is the most crucial part. In the case of roads, it is annually reset. In the case of transmission or renewables, it's set upfront, right? And in the case of airports, it's at periodic intervals, etc.
Right.
Then people have a good certainty of how the tariffs would play out. From an investor's perspective, to whom we are addressing this conversation to, most of the infrastructure as an asset class shows a high degree of correlation to GDP.
Correct.
If you and I, as proud Indians, believe that Indian GDP is going to grow at 5 to 6% for a long period of time,
right,
that means you expect the usage of that infrastructure to be having a high degree of correlation to that.
Right.
Whether it is energy consumption, transportation, logistics, whichever way you look at it.
Right.
So there is an underlying growth that is there. The tariff setting is transparent, known upfront, right? So that, and the concession agreement is allocating risks properly. So while I would not say that the investment manager is just having a good time and really not doing its job, but the fact is that it is not that you are taking a punt on an idea or you need to have a deep knowledge of it which could go wrong, etc.
Right. Okay.
Normally things cross correct. And lastly, I'll go back to the point that I made earlier. Diversification is the key. Even in the roads InvITs or renewables InvITs, you would see that the InvITs which have become more and more successful or become larger are offering a diversified portfolio.
Different geographies.
Different geographies. For example, in NHAI InvIT, you spoke about 2,600 crores order of revenue, but we were present across 19 states.
Okay.
Right? And we had no single commodity that was traveling on our roads, more than 10%.
Okay.
Right? We had import-export cargo, industrial cargo, agriculture goods, etc., etc.
Right.
We had concrete roads versus bitumen roads, etc. As you offer diversification of risks, you don't go only roads which are close to the coasts, right? You don't go take all the roads close to the mountains. So that's how one manages these risks, which the investment manager is perfectly capable of.
Suresh, I had one last question. There are projections that the AUM of InvITs will cross, 20 lakh crores in the next 5 years. I think very optimistic projections. And, you've been saying that, the ambition is to make InvITs mainstream, like equities, bonds, mutual funds, etc. So what do you think would be the enablers for this to happen?
I would think two enablers is what, one in the control of the government and the other probably from the private sector. I think it's well established that there is adequate amount of capital, both foreign and domestic, which will be attracted to invest into Indian infrastructure.
Right.
And there is no going to be constraint on that. I think our constraint has been more around supply of assets.
Right.
Right. And that's the first enabler is coming to be that how we can facilitate government's assets, which have hitherto not been put into InvITs, to come out. This includes state government's assets,
Right.
And that's where the point I'm making
Right.
about national InvIT or whatever it is,
Right.
is something that should be explored. And certainly it's good for the country, good for the investors, a diversion of savings from only equity capital markets to infrastructure, national assets, etc. It's good for everyone. The second part of that is on the private sector. A lot of categories of infrastructure or sectors within infrastructure are being led by the private sector. They essentially happen to be on the energy transition side, batteries.
Right.
They happen to be in digital infrastructure side, which includes telecom towers, fiber,
Right.
data centers, etc. And then we are also seeing a lot more social infrastructure investing by the private sector into social infrastructure. So I expect that these assets, which are at the initial stages of investment at this point in time,
Right.
would be ripe to come into the InvITs.
Right.
So same conversation 2 years from now, I can assure you that we would have more number of InvITs, more number of investors, and more sectors within those InvITs than probably we have today.
Thank you so much, Suresh, for sparing time. This has been really a fascinating conversation.
Thank you, sir. Thank you for inviting me. I do hope that I was able to share some insight on the InvITs, but like I said, I've always enjoyed interacting with you. Thank you again.